Getting on the property ladder, or anywhere near it for that matter, can feel like an impossible task these days. But with property investments, you can invest with amounts as little as £1, and depending on your options, you aren't restricted to actually buying physical bricks and mortar. If you want to know more, this video will take you through some of the key reasons why people invest in property, as well as your 6 main investment options and some of the risks involved. In the last decade, savings rates have consistently fallen well behind the rate of inflation. So if you invested your money in a savings account, you would have effectively lost money. Over the same period, average UK house prices have risen above inflation, making property investment a potentially very lucrative move. Aside from the money-making potential, each of the 6 investment options I'm going to run through come with their own additional benefits. For example, if you buy to let, you can collect a passive income through rent. Property stocks and shares can add diversity to your investment portfolio. And for some, property investments simply add a little peace of mind, as they can feel like more tangible investments compared with other stocks and shares. If you don't have the cash to buy a house, investing in the stock market could be a good option, as with the right platform, you can invest with as little as £1. Adding property to your wider portfolio could lend diversity to your investments, which could help mitigate your investment risk. But even with indirect property investments, such as through stocks and shares, you're still vulnerable to the same fluctuations in rental demand and property prices that affect buy-to-let owners. Property funds can also be forced to stop trading if lots of investors want to sell at the same time, so you'll be blocked from selling any of your investments until these restrictions are lifted. And just because you're buying shares in property companies, it doesn't mean your investment is any less risky. Wider economic factors could still see the value of your shares fall instead of rise. Buying a property to lease out to renters is a popular investment option. You'll want to thoroughly research the area or neighbourhood you're looking to buy in to ensure there's good rental demand and competitive rates. Even with a buy-to-let mortgage, you'll typically be expected to have a minimum annual income. And it's worth knowing that buy-to-let mortgages usually require a higher minimum deposit, typically around 20%, and the interest rates tend to be higher than on conventional residential mortgages. Between safety certificates, maintenance and mortgage repayments, plus finding and managing tenants, a buy-to-let investment can be a time-consuming and costly endeavour. If you don't keep up the payments, you risk your property being repossessed, and there's no guarantee you'll make a profit even if you decide to sell. Property developing, otherwise known as flipping houses, typically involves buying a property in need of work, doing a load of snazzy renovations, and then sticking it back on the market at a much higher price. Be mindful though that watching a few episodes of Homes Under the Hammer doesn't qualify you as a DIY expert. Even with a team and loads of experience behind you, flipping houses is both a full-time job and a huge financial commitment. So if that cheap fixer-upper feels too good to be true, chances are it is, and you could end up forking out for fundamental repairs and maintenance. Be aware that capital gains tax could apply to any profits when reselling a property that has not been your main residence, and consider the risks that if renovations take longer than expected and the housing market takes a downturn, you could lose some of your projected profits when you sell. These are essentially stocks and shares ISAs, where your money is invested in property funds that purchase buy-to-let properties. When it's going well, it's a win-win, as you could benefit from both the rise in property value and the rental income. Plus, as it's an ISA, you can invest up to 20 grand a year and you won't pay tax on any profits. Remember, no stock market investment is without risk, and the value of your shares could go down as likely as they could go up. With land banking schemes, you basically buy a plot of land without planning permission, with the aim of making money from the increase in value when it does. Obviously, this is a very risky strategy, as the land may never get planning permission, especially if it's protected. And these schemes are also not regulated by the Financial Conduct Authority, and many can turn out to be scams. Peer-to-peer or P2P lending is where a peer-to-peer company collects money from its investors and lends it out to individuals in the form of buy-to-let mortgages. Because your investment is split and lent out to a large number of borrowers and therefore a large number of properties, your investment is less affected should one borrower default on their loan. That said, P2P lending isn't without risks, as these investments aren't protected by the Financial Services Compensation Scheme. So if the P2P company goes bust, you could lose your investment. The type of investment you make will largely depend on your goals. Are you planning on making this your full-time job? Maybe you just want a little extra income every month or to add some spice to your investment portfolio. For more in-depth information on property investments, head to finder.com/UK. Links are in the description below. For more videos like this one, hit the subscribe button here or stay tuned for our next video. And as always, thanks for watching.